All right, today we're diving into a huge question in Indian finance, one that's been bugging investors for years. Why are some of the country's absolute biggest, most well-known companies still not on the stock market? Let's get into it. I mean, really think about it. You've got Reliance Jio, the national stock exchange itself, Flipkart. These are names we all know, true titans of Indian business. But if you wanted to own a piece of them, you can't. They've been teasing IPOs for what feels like forever, so what's the actual holdup? Well, it turns out this isn't just a coincidence. There's a very specific reason these corporate giants are all stuck in this kind of IPO waiting room. It's a massive logjam, and it all comes down to the rules of the game. So let's talk about that bottleneck. The problem is rooted in India's current IPO regulations. Now, they were created with good intentions, for sure, but they've ended up creating some major hurdles for the biggest of the big. To really get this, we need to understand one key term, free float. All it means is the slice of a company that has to be sold to the public so it can be traded freely. It's the part that's not locked up by the founders or big insiders. It's the part for people like you and me. And the rules around this are at the very heart of this entire issue. And here are the two big rules that basically scare these giants away. First, if you're a company worth over 1 lakh crore, you have to sell at least 5% of your company in the IPO. And second, you're immediately put on the clock. You have just 5 years to get that public ownership all the way up to 25%. For a company of that size, that is a massive and incredibly fast dilution of control. And the numbers we're talking about, they're just staggering. India's market regulator, SEBI, laid it out in a paper. For a company valued at 10 lakh crore, think a Reliance Jio. The current rules would demand an IPO worth 55,000 crores. That is such a colossal amount of money, it could practically suck all the liquidity out of the entire market. So, facing this huge logjam, SEBI has finally put a plan on the table. They've put out a consultation paper with some pretty radical fixes designed to, well, break the bottleneck and finally get these giants onto the stock market. And here's the heart of the proposal. They want to dramatically lower the barrier to entry. Instead of needing to sell a minimum of 5%, the idea is to cut that initial float in half, down to just 2.5% for these truly massive companies. And just look at the difference this would make in practice. For a company like Jio, this one simple change cuts the required IPO size from over 50,000 crores all the way down to a much more digestible 25,000 crores. All of a sudden, an IPO that seemed almost impossible starts to look very possible. But that's not all. The proposal also gives these huge companies more breathing room. It would extend the deadline to reach that 25% public float from 5 years to potentially 10. Plus, they're looking at creating an official, regulated platform for pre-IPO trading, basically trying to bring all that activity from this shady gray market out into the open. So let's play this out. What happens if these rules actually become law? Well, it wouldn't just unlock a few big IPOs, it could create a whole new IPO economy with some serious ripple effects across the board. The most obvious winners here? The investment bankers and brokers. A flood of these mega IPOs would be an absolute feast of advisory fees. Just look at the recent Hyundai IPO. The banks on that deal made nearly 500 crores. Now imagine a steady stream of deals that size, or even bigger. And for brokers, it would be a frenzy of activity, processing millions of new applications, just like we saw with the LIC IPO. Okay, now think about the fund managers. A newly listed giant like Jio would almost certainly get fast-tracked into major indexes like the Nifty 50. This sets off a chain reaction of what's called forced buying. Basically, every single index fund and ETF that tracks the Nifty would have to buy Jio shares to stay balanced. That would trigger a massive reshuffling of money across the entire industry. So what about the small retail investor, you and me? Well, honestly, it's a bit of a mixed bag. The great news is you'd finally get a chance to invest in these incredible, iconic companies. The bad news? Because the initial slice of the company being sold is smaller, the oversubscription could be, and I'm quoting here, brutal, which means that your chances of actually getting an allotment could get even slimmer than they already are. So let's zoom out for a second. Are India's rules really that tough to begin with when you look at the rest of the world? And what are the real risks of making them easier? When you look at this global snapshot, you can see that, yeah, India's rules are actually pretty strict. I mean, the world's biggest IPO ever, Saudi Aramco, listed with just a 1.6% float. Places like Hong Kong and Singapore are flexible.
And even in the US, a giant like Facebook sold less than 15%. This context really shows that what SEBI is proposing is less about being radical and more about aligning India with global standards for these mega listings.
But of course, making things easier isn't risk-free. With such a tiny percentage of shares actually available for trading, you could see some wild price swings right after listing. A smaller public float also means less public oversight and potentially weaker corporate governance. And then there's the crowding out effect, where these giant IPOs absorb so much investor cash that smaller, deserving companies might get left in the dust. So what this all really comes down to is a very, very delicate and high-stakes balancing act for India's regulators. And it's a decision that has decades of market history behind it. This timeline really puts it all into perspective. Can you believe that back in 1993, the minimum public float was a whopping 60%? The journey from that all the way down to a proposed 2.5% initial float, it just shows a dramatic shift in thinking, one that reflects a market that has truly grown out. And that brings us right to the fundamental trade-off that regulators are wrestling with. Is it better to relax the rules to make sure your country's biggest and best companies list on your own stock exchanges, adding credibility and depth to the market, or do you hold firm on demanding higher public ownership, even if it means those same giants decide to list somewhere else? That is the decision on the table. This isn't just some minor technical change. This is a move that could fundamentally reshape India's stock market and investment flows for a generation to come. So the big question is, will this finally unlock a new, vibrant era for the Indian market, or will this solution end up creating a whole new set of problems? We'll have to wait and see.